Okay, this is a paper called Global Tactical Cross-Asset Allocation, Applying Value and Momentum Across Asset Classes. This is written by David Blitz and Pim Van Vliet, and they are both from the Robeco Asset Management in the Netherlands, and this was published in October of 2007. So let's jump into it. So they start out with the definition of global tactical asset allocation, and that's the process of trying to tilt the portfolio to certain asset classes that you think are more attractive than maybe the benchmark. And so they suggest that this can be done by using a lot of different models in conjunction to ultimately tilt your portfolio to the asset classes that you want. For instance, you have a market timing model, bond timing model, country allocation, so on and so forth to get to your final allocation. And they call these building block models. And so a lot of other previous researchers have found different ways or different models, for instance the term spread and the dividend yield, and predicting the equity risk premium. And then same thing can be done with the bonds, and even momentum or mean reversion can be used for country allocation, or maybe even carry strategies for currencies. But the traditional approach, which was discussed up here, kind of simplifies the process by breaking it down into a lot of different smaller problems to handle separately and building the allocation. But the authors note that by separating into these different smaller decisions, you're not comparing each asset to every other asset that could possibly be invested in, and that leaves a lot of potential unrealized. And another drawback says that it takes a little while to develop all of the separate models, and so you can only really have a limited number of models, or it'll take too much time to build. And also by using all these different models, you really have to have a sophisticated risk budgeting approach to manage all the differences in the portfolio. And so in this paper, the authors are going to propose a new allocation approach that they dub the global tactical cross-asset allocation. And this model will be a single model. It won't be the building block approach that was discussed before. And so what they want to find, they say, by doing this approach is to see if the cross-sectional return patterns can be documented across the asset classes rather than just at the security level, which has been done in the past. So they note that if they can find a profitable strategy by using this allocation approach, it will certainly be a big challenge to market efficiency. So now they're going through a few previous papers, like Jagadish and Titman's 93 paper that found strong momentum returns over the next 6 months, and Fama French in 96, who found that that size and value premiums can explain market returns, and they introduced the 12-1 month momentum strategy as well. Also, Fama French and Ruenhorst found the value and momentum premiums in international markets, and other authors have found momentum and cross-market perspectives in the futures markets. And other authors have found short-term reversal effects at the stock level and at the industry level. And so in this paper they're going to examine value and momentum strategies for tactical allocation across a broad range of asset classes. In particular, they're going to be looking at price momentum, which would be ranking according to past returns of the stock price. And they're going to look at both the 12-1 month momentum strategy, and that's where they look at the past returns of the past 1 year, excluding the most recent month, and also a 1 month return strategy. And in approaching the value allocation, it looks like they're going to use relatively simple yield measures to rank the value in each of the asset classes. And so what they found in their study is that the application of momentum and value strategies in their tactical asset allocation across 12 asset classes delivers statistically and economically significant abnormal returns. And it looks like they found 7 to 8% return premiums for the 1 month and the 12 minus 1 month momentum strategies, as well as the value strategy over the 86 to 2007 period. And the study corroborates the 1 month momentum effect at the industry level, but contradicts prior studies' effects at the stock level. And even when they combine momentum and value factors, they get an alpha of 12% per year. And that performance is stable over time and even overcomes transaction costs in practice. And also the performance is largely unaffected by normal risk adjusting measures, for instance the CAPM, market factor, the Fama French size and value factors, and the Carhart momentum factors. And the authors suggest that their findings are relevant for both theoretical and practical reasons. From a theoretical perspective, their findings may challenge market efficiency as well as market equilibrium. And they find that market or momentum and value factors aren't just present within specific asset classes, but they're also across entire asset classes. And they note that no asset pricing model is likely to explain these results. And so the authors are going to provide a possible behavioral explanation for the momentum and value effects which they found across these asset classes. And so for practitioners, their findings are good because it provides a single model approach rather than the building block model, which we discussed at the beginning. The only thing that might be tough is that there's hard to have a specific variable across all of the asset classes. For instance, equities might use particular variables, for instance, analyst earnings revisions, and the bonds may use other types of variables, but which may not be appropriate for the equity markets. So in their model, they're using variables that can be used across all of the asset classes, or a limited number of factors, instead of diving deep into the allocation with different types of factors. So the rest of the paper is organized as follows. The first section is the data and methodology. And next they're going to present the results of their momentum evaluation strategies using their global tactical cross-asset allocation. And the next sections contain various robustness tests, and then a discussion of possible explanations for their findings. And then there's a conclusion and implications for investors. Okay, so let's look at the first section, data and methodology. So they have Exhibit 1, which gives an overview of the asset classes that are the opportunity set for the analysis that they're doing. So let's go down to Exhibit 1. Look at the asset classes that they've chosen. Okay, so they have so it looks like they have a total of 12 different asset classes, and they have an index for each of these. And we have 3 from the U.S. equity market. Here's a large cap, mid cap, and some REITs. And they also have 3 international asset classes, or international equity asset classes, so UK, Japan, and the emerging markets. They have 3 U.S. bond asset classes. So they've got treasuries, investment grade bonds, and high yield bonds. And they've got two international bond markets, so Germany and Japan. And they've got the 1-month LIBOR here as a proxy for the risk-free rate. And so they've got data for each of these indices going back to these dates here. So back to 1970 for with the S&P 500, a little bit more recent for these international bond groups. But so let's go back up to the discussion here. So they set up these asset classes rather informally, but they used a few set of rules. For instance, there needed to be at least 20 years of data. They didn't include asset classes that are tough to model, for instance commodities and currencies. They didn't include illiquid securities or those that have a lack of market prices, for instance direct real estate or private equity. And they didn't include micro cap stocks. And they didn't want to include highly correlated asset classes that would kind of go against the usefulness of the study by, for instance, they included the 20 largest stock markets. It would kind of, as asset class, separate asset classes, then there would be kind of moot, because the allocation would be somewhat indifferent between choosing between each of those stock markets. So what they did is, for each asset class, except the emerging market equities, they took the total return in the local currency of that index, subtracted the local risk-free return, so that would be the 1-month LIBOR, and that would be the excess returns of that particular index, and that would simulate kind of what a futures contract might earn you. So if we remember from Exhibit 1, the earliest date where there's data available for every one of the asset classes was 1985. And since we're using the 12 minus 1 month momentum strategy, that would mean the past returns over the past year, excluding the most recent month, then our first year of returns from the strategy are going to be in 1986, because we had to wait a year after January 1985. And it looks like that works out, because that's the first month that valuation data is available for every asset as well. And the last month of their sample period is September 2007, and that's about the date when their paper was published, so they went through as far as they could. And it looks like Exhibit 2 is going to summarize the risk and return characteristics of each asset class. So let's go down to Exhibit 2 and see how each of the asset classes performed. So we've got all the asset classes here. We also have the geometric mean return, and as we discussed, this will be the return over the year, or over the past average annual return minus the 1-month LIBOR, so the excess returns here. We also have a standard deviation of those returns, and so the mean divided by the standard deviation will give us the Sharpe ratio. We can see here that emerging markets gave the highest excess return, but that also came with a lot of volatility, so our Sharpe ratio is kind of in line with a lot of other ones. The Japan equity looks like performed the worst, 0.7% annual excess return on average, with a pretty high volatility, so the Sharpe ratio is really, really low. It looks like the bond markets came in, returns pretty low, but they also had pretty low volatility as well, so that gives us a Sharpe ratio in line with some of the asset classes, or some of the equity asset classes. So that's how each of the different asset classes has performed. So let's go back up to the discussion where we start allocating and forming some portfolios. Okay, so it looks like what they're doing is every month they rank all of the asset classes according to their momentum and or valuation scores, and they put them into quartiles. So that's four different portfolios with 3 assets each. So you remember we have 12 asset classes, so they rank them and then put the top 3 asset classes in one quartile, the next 3 in the next quartile, and so on and so forth. So each quartile will have 3 assets in it, or 3 asset classes. And so with each of the quartiles, they will calculate the 1-month return. And it looks like they're also going to calculate the returns of a winner minus loser portfolio. For instance, the top quartile minus the bottom quartiles if they went long the top and short the bottom. And that process is repeated till the end of the sample period. And it looks like later on they will discuss transaction costs related to this. And so they want to explain here that the process they're using to build these portfolios is kind of in line with some prior studies as well. But they want to warn that using a long-short strategy in this way might result in some odd pairings of longs and shorts. For instance, not the normal ones, for instance, going long equities and short treasuries, but something odd like long U.S. real estate and short Japanese government bonds, which would be kind of unusual, but could certainly turn out to be the case when allocating the portfolio in this way. And so related to momentum, they're going to use both the 1-month return strategy and the classic 12-1 strategy that we've discussed before. And in addition to the momentum strategies, they use a cross-asset valuation strategy. And this one's a little bit more difficult because the momentum strategy just uses past prices, which is easy to pull. But the valuation strategy has to use some actual fundamental data, which is a little more difficult to pull and compile. So for equity asset classes, they're going to use a trailing earnings yield, which would be the earnings divided by the price. For the bond asset classes, they'll use a standard yield to maturity. And both of those were adjusted for the local risk-free rate of return. And they want to reiterate that doing this with bonds actually gives the term premium, which is basically the yield of the bonds less the risk-free rate, so the risk premium there. And the authors are really well aware of the simplicity of this strategy that they're using. And so they're making a few adjustments to make it more in line with maybe what's economically rational. For instance, without their adjustments, it may turn out that maybe high yield bonds may turn out to be structurally preferred over U.S. Treasury bonds if we don't take into account the default risk that we're taking when taking on the high yield bonds. And in fact, when you don't make this adjustment, it turns out that you get high yield bonds over Treasury bonds 93% of the time, and that's probably not real world effective. And also they note that basic yield measures may need to be implemented because it's kind of difficult to compare government bonds to stocks because they're valued differently and have different cash flow specifications. So anyway, to do this, they made a few adjustments to the asset classes to remove the biases within them. So, for instance, the government bond assets, for instance, at the U.S., German, and Japanese, they reduced the premium by 1% to take into effect that the yield curve tends to be upward sloping for those particular securities. And for U.S. investment grade bonds, they subtract the yield by 2%, and the U.S. high yield they subtract by 6%. This is to adjust for this upward sloping yield curve as well as the default risk in those securities. For the emerging market equities, they subtract 1% to adjust for the lower PE compared to more mature markets. And for U.S. real estate equities, they subtract 2% to adjust for the higher yield compared to regular equities. So for Exhibit 3, they have the adjustments that they made. So let's take a look at Exhibit 3. So here that have the asset class as well as the valuation measure. Looks like earnings yield, dividend yield, and the term yield here for different bonds. So it looks like this is the average without the adjustment, and then here's the column with the adjustments. So they're subtracting by 2%, by 1%, 2%, so on and so forth, like we just discussed, to get to the average adjusted hurdle rate. And these actually end up being between -0.1 or -1 and +1%. So they find that that means these adjustments were pretty accurate and effective. So let's go back up to the discussion. And so for the valuation or the value portfolios, they're going to be structured similarly to the way that the momentum portfolios were structured before, where they're split into quartiles and monthly rebalancing. And they're also going to combine the value and momentum effects into a combined investment strategy. And to do that, they're going to rank the asset classes according to the individual variables, the value and momentum variables. And then half is going to be allocated to momentum and half is going to be allocated to value. And so in that way, it's going to be 25% for the 1 month momentum, 25% for the 12-1 momentum, and then 50% for the valuation. And they say their choice of weights was chosen somewhat because of the correlation structure, which they're going to discuss a little bit later.